Have you ever looked at your savings account and felt confused about why it is not growing, even though you are working harder than ever? Prices keep rising, and the stock market feels like a casino you never agreed to enter. Right now, many Americans feel stuck between inflation, high interest rates, and headlines warning that something is breaking beneath the surface of Wall Street. Groceries cost more, rent feels heavier, and one bad market week can erase years of careful saving. The fear is quiet, but it is everywhere. This is Crypto Brain Power, a channel built for beginners who want to understand markets without hype, without promises, and without feeling stupid for asking simple questions. The goal here is clarity, patience, and learning how the system really works, one step at a time. Before we continue, let me know in the comments what stock market topic you want explained next. Whether it is crashes, long-term investing, or how to read economic data. Subscribe to support the channel and continue learning with us. When people hear the word crash, they imagine one dramatic day when everything collapses. But real market damage usually begins quietly. Long before prices fall, signals appear in places most people ignore. The question is not whether the market will ever fall again. History shows it always does. The real question is whether people understand the warning signs or keep moving forward without noticing the ground shifting beneath them. In recent years, the US stock market has felt unstoppable. Big names like Apple, Tesla, and Amazon became symbols of safety and growth. The S&P 500 climbed while millions of new investors joined through platforms like Robinhood, Fidelity, and Charles Schwab. For many households, investing stopped feeling optional and started feeling like the only way to survive inflation. But that feeling itself can be dangerous. One early warning sign Wall Street watches closely is valuation. This simply means how expensive stocks are compared to the profits companies actually make. When prices rise much faster than earnings, the market becomes fragile. It does not mean prices must fall tomorrow, but it means expectations are stretched thin. Even strong companies can suffer if reality fails to match optimism. Another signal comes from interest rates. When the Federal Reserve raises rates, borrowing becomes more expensive. Mortgages, car loans, credit cards, and business loans all feel the pressure. This slows spending, hiring, and expansion. Federal Reserve meetings are not just news events. They quietly reshape the cost of money across the entire economy. Inflation data, measured through CPI reports, is another piece of the puzzle. When inflation stays high, the Fed is forced to keep policy tight. That tension creates uncertainty. Markets dislike uncertainty more than bad news. Jobs reports add to this picture by revealing whether companies are expanding or quietly preparing for leaner times. Then there is corporate behavior. When executives slow hiring, reduce guidance, or quietly cut costs, it often means they see softer demand ahead. Layoffs do not always appear suddenly. Sometimes they start with hiring freezes and cautious language in earnings calls that most people never listen to. The stock market is also emotional. When markets rise for years, people stop thinking in probabilities and start thinking in guarantees. Losses feel impossible until they happen. During past downturns, many investors sold near the bottom not because they were wrong, but because fear overwhelmed their plan. Think back to previous market shocks. The financial crisis did not start with panic. It started with confidence in systems people barely understood. The pandemic crash felt sudden, but the recovery showed how unpredictable markets can be. These moments remind us that timing markets is nearly impossible, and reacting emotionally often does more damage than the event itself. Retail investors today face a unique challenge. Apps make buying and selling easy, but they also make panic fast. Watching prices update every second can turn small dips into emotional emergencies. Long-term investing becomes difficult when every headline feels urgent. None of this means a crash is guaranteed in 2026. Markets move based on millions of decisions, not predictions. What matters is understanding risk and uncertainty as permanent features of investing, not temporary problems to be avoided. Strong companies can still struggle during economic slowdowns. Indexes like the S&P 500 reflect broad trends, not individual stories. Even diversified portfolios experience volatility. This is not failure. It is how markets function. Learning the stock market is not about finding the perfect moment. It is about building discipline, understanding cycles, and accepting that patience is often the most powerful strategy. Real confidence does not come from knowing what will happen next. It comes from knowing how to respond when things do not go as planned. If you have lived through a market drop before, you remember the fear. If you have not, the fear is still ahead at some point. What changes outcomes is preparation, not prediction. Markets reward those who stay informed, realistic, and emotionally steady over long periods of time. The stock market does not exist to make anyone comfortable. It reflects the economy, human behavior, and uncertainty all at once. Understanding that truth removes the illusion and replaces it with something quieter and more reliable. As inflation shifts, as the Federal Reserve adjusts policy, and as companies adapt, the market will continue doing what it has always done. It will rise, fall, confuse, and test patience. The goal is not to outsmart it, but to understand it. This video is only for educational purpose, not financial advice.